Hey everybody, I'm James Kleimann. I'm the managing editor at HousingWire, and I'm here with HomeLight, Nick Friedman.
Yeah.
Nice to see you.
Nice to see you as well.
I wanted to talk a little bit about this report. So I was in New Jersey. I was in Atlantic City for the New Jersey Regional MBA, and they have White House subs, which if you ever end up in Atlantic City, you have to go. It's the best sandwich you eat in America.
Cool.
But that as an aside, they talked a lot about this explosion in non-QM lending, that a lot of these, especially with the brokers, a lot of people are moving in because, you know, the credit box is relatively narrow for conventional conforming mortgages, and affordability is a big freaking problem and probably will be for the foreseeable future. I know you guys just came out with a report. You've been looking at all the numbers, sales, concessions, all this.
Yeah.
Could you maybe, am I wrong? Like, is non-QM having a moment right now?
You're totally right. I think 75% of loan officers say that non-QM is the most commonly requested mortgage type right now.
Really?
Which is kind of crazy.
That's insane.
Yeah, it's weird, right? It's like you would never expect that 3 or 4 years ago. I think the problem is that loan officers are finding it difficult to adopt these non-QM products, right? If you do an underwrite on a non-QM loan, sometimes it takes 6 days just to get the underwrite back. And it's very complicated. There's a lot of different guidelines, et cetera, right? So I think it's really difficult for a lot of people to kind of adapt to that type of program right now.
And they don't have a scenario desk, or they, they don't have the infrastructure built up unless you started doing this a couple of years ago, like a CCM or somebody.
Yeah,
right?
yeah. The scenario desk is Excel spreadsheets right now, right? From all these different lenders who just and it's just, and I've seen them and they're kind of impressive, honestly. There's so many formulas and everything, and all these little squares, and you type in a couple things, and it's their own little pricing engine or whatever. But they do it for one non-QM product, and then they're like, oh wow, this took a long time. I don't want to do it for the other 15 that I have, and they just end up using that one, and that's their core product, right? And so I think any sort of technology or tools out there that could help them basically, provide the client with the best possible solution across any of these products would be really interesting.
And when you think about the demographics, there's so many changes. Like, and it's not just Uber drivers. There are a lot of self-employed borrowers out there. There are a lot of entrepreneurs out there who can make use of these products. There are a lot of people on OnlyFans. We shouldn't be judgy, right? Like, there are so many people out there who don't neatly fit into the current mortgage market. Yeah.
And there's just a lot of interesting ways to make money, right? I did 20 years ago, a lot of people just did the standard. I'm going to go to college, I'm going to get a job, and I'm going to, just make money the way that my parents made money. Right. And I think now it's not like that. Like, you talk to people and it's really interesting. Anybody in their 20s or just out of college, or even not choosing not to go to college. Like, those are people who are sometimes making a ton of money doing things that you would never expect. And those things are not things that Fannie Mae and Freddie Mac have necessarily accounted for, right?
And probably won't for some time.
And probably won't for a long time.
Yeah,
exactly.
So. And it's interesting because when you do find a way, not that I know a lot of Gen Zers who are able to even come up with anything close to a down payment, even with DPA, even with what's left of the special purpose credit programs, if there are any, right, outside of the private lending space. I feel like you need some assistance. I know you guys have been checking out some of the numbers behind seller concessions and all that. Like, what are the trends there? What are you seeing?
Yeah, so 44% of purchases have a seller concession on them right now.
Okay, that makes sense to me.
Which makes sense.
And is it mostly in the markets where we were talking about my hometown of Wyckoff? There are 6 houses for sale right now, right? Yeah. There are no seller concessions.
Right,
right, because there are going to be 80 offers on every single house.
Totally. It's mostly in less competitive situations.
Okay, that makes sense.
And again, I think what's interesting is most sellers are also buyers. And when they're going through the process today, they realize, hey, it's really tricky to qualify for a home when I'm buying and selling as well. And so what happens is they're much more willing to give concessions because there's some empathy there, right? It's like, hey, I'm having trouble buying my next house. I'm asking for concessions there. I'll give you some concessions too. It becomes a concession train across the board. And I think that people are just a little bit more collaborative today. So there's kind of a nice thing about, hey, the sellers and buyers are working together to get these deals done in these less competitive markets. Now, like you said, in the markets where there's 6 homes for sale and there's thousands of buyers trying to get them, you're not going to have that.
Right. That maybe that makes sense for like a final offer product, which is a little bit different, right?
Exactly. Yeah.
Where you can kind of have more of a control over the process, whereas you're not going to have a fighting chance if you're asking for concessions on a house that has 80 bids, right?
Absolutely.
Yeah. Right. So talk to me about some of the other trends that you guys have been checking out.
Yeah.
The things that are percolating, things that we hear anecdotally, but I don't know, like, is that true?
Yeah. So I
think got the data.
I think a really interesting one is the most common reason that buyers are not moving through a pipeline for a loan officer is DTI being too high.
Yeah, that fits.
Right. Which makes total sense.
That's probably why we're seeing more people moving over to the FHA products,
exactly,
right?
Exactly. And any sort of non-QM product that can help you kind of get there. Bank statement loans are getting more common. I'm seeing those as well. So that's a really big trend. We see buy downs being a huge trend right now.
Okay.
I believe it's
2-1s mostly.
2-1s are the most common. I believe 58% of loan officers say that they've seen an increase in buy downs in the last little bit here, in the last year. And so I think, again, people are just trying to find unique solutions to get into the home that they want. I think that the buy down conversation is always really interesting, whether it's worth it for the client or not. I think that clients get buyers get very rate sensitive, and they don't think about the payment, right? So they like to go and brag, hey, I've got a 4% rate, I've got a 5% rate. But really what's important is, hey, what are you actually paying your monthly for this home?
It's always your monthly.
Right? And so I think that people get lost in that a little bit, but the buy down's a great tool to attract the client and say, hey, I'm a loan officer. I've got, this client who wants a 4.5. I can give them a 4.5. It's just, I have to use a mechanism called a buy down, and here's how we're going to do it. And people will pay. Right. But I find it interesting that people are going to come up with 30 grand to do a buy down.
Yep.
Like, why don't you just,
maybe that wasn't the best way to do it.
Maybe it's not the best. And maybe you're only going to be in your home for 3 years or 4 years, right? There's not really as much of an issue there. And then also refinancing. At some point, rates will go below where they are now, and you can
they keep telling me this.
That's what they say. Yeah, that's what they say. That's what they say.
Well, let's talk about all the people who got those 2-1 buy downs in 2022.
Yeah.
Right. Yeah. They're probably not feeling so hot right now.
Exactly.
Now that, that's expired effectively.
Yeah.
Right. And I know there are some lenders who are honoring them and saying, we're going to try to make this cost a little bit
more feasible.
More feasible for you.
Yep.
Yeah. Are you noticing any geographic trends? We know all the new home sales seem to be in the South and kind of the Sun Belt area. Anything else you guys are picking up geographically?
Yeah, the only thing we're seeing is Florida and Texas are moving very slow right now. There's a lot of saturation in those markets, especially southwestern Florida. So on the Gulf side, we're seeing a lot of just really slow moving inventory there, way slower than we've seen in a long time. And then in the Texas market, it's really just a lot of new builds and a lot of saturation out there.
And in Florida, mostly the insurance issues, I'm guessing.
Insurance issues is a huge piece of it.
And then just a lot of condos there as well, right?
A lot of condos.
And so
it's
like my dad has been trying to sell a condo in Florida for God, I can't even
tell you. Oh yeah, no, it's like everyone I talk to is
just going to die with that condo.
Yeah.
I'm going to inherit this shit box.
Yeah. You'll have it for a while.
Awesome. That's great.
We can go grab a drink in your Florida condo sometime.
I don't want to. It's like I find like Orlando like the worst place. Like I couldn't.
I love it.
Okay, so your product, you guys you're working on a lot of bridge loan products. You're working with borrowers, with lenders. Tell me about what you guys have been up to lately. What you're working on right now. What are the problems that you're trying to?
Yeah, so the big problem, and going back to this DTI issue, right? A lot of people come to a loan officer and they say, hey, I've got perfect credit, I've got good income, all this good stuff, but I have a home that I need to sell. Right. And if I don't sell my home, I can't actually qualify. The loan officer looks at the DTI, it's too high. They say, hey, come back to me once you've sold your house. Now, all of a sudden, the loan officer's like, well, I don't know if this person's ever going to come back. Right. If they don't sell their house, it could take 6 months. It could take, if it's a Florida condo, it could take a really, really long time. Right. So it could take a while to get the home sold. And so in those scenarios, the loan officer is kind of at a loss for making an immediate impact with that client. And so what we've done is basically said, how do we allow that client to buy their next home first, immediately, right now, remove any sort of liability associated with that existing property, and make sure their DTI is actually, doable for the transaction, right? And so we built a program called Buy Before You Sell, very, very much what it sounds like, right? And we basically place an offer on the client's existing property, which basically frees up their ability to be a non-contingent buyer. So go in with a really strong offer on the new home, and also allows that loan officer to remove the existing mortgage liability for the client. So now all of a sudden they can go in and they can buy that next home without counting the existing mortgage liability, and they can qualify, right?
And you take a point, I guess, or whatever.
So our fee is 2.4% for doing this if they're also using a bridge loan. So we offer bridge loans as well. There's 0% interest, and they can just borrow the money to go buy their next house. So that also accomplishes the problem of, hey, there's $14 trillion of debt or whatever. Sorry, $14 trillion of debt. There's that too. There's $14 trillion of equity.
I think between the two of us by now, with this Florida condo and everything else.
Yeah, exactly. We got a lot of debt going on, but 14 trillion of home equity, right? And so to tap
tappable home equity.
Tappable home
There's
equity.
about, I think it's 30,
even more.
total?
Yeah. Actual total. Yeah.
It's quite a bit.
And so if you think about that, right, people who are buying their next house, they really don't want to take it out of their savings. They don't want to liquidate retirement or whatever it is. They want to just be able to take it out of their house and just move it, right? And so we allow them to use the bridge loan as well. The cost for that program is 2.4%. We have another product called DTI Drop, and that's just if you're not using the bridge loan, if you're just using the mortgage liability removal piece.
And so the way that you're working with these end users, are you mostly going through the agent because they're the trusted kind of confidant, or is it the LO?
Yeah, it's interesting.
How are you kind of working with?
So we actually go through the loan officer, and the reason why is we've seen that it is a financial product, right? Especially when we have a bridge loan involved. Sure. DTI adjustments are all handled by the lender, right? And so we found that a lot of loan officers have been selling the product alongside the mortgage. So for example, if they're doing, a 7-1 ARM, right? They can say, hey, we're doing a 7-1 ARM buy before you sell. And they just loop it together as one thing. And it helps the client understand, hey, here's what my product actually looks like. And I find that to be a very interesting way for loan officers to sell the product. Loan officers also love to talk to agents and clients, obviously. And so what we've relied on is them actually spreading the word and keeping control of the agent and the client. We don't want to be involved in that. We've completely white labeled the program for the loan officers. And so we've partnered with hundreds of lenders around the country. And, it's not our product. It's the Fairway Buy Before You Sell program or the Cross Country Buy Before You Sell program. It's not the,
that makes sense.
HomeLight Buy Before You Sell program, at least so that way the clients and agents that are working with the loan officer can get a really customized and tailored experience from that loan officer.
And they don't know who HomeLight is. They don't want another
exactly
proper noun that they have to think about or worry about.
And we don't want credit for it, right?
Right.
We're doing our thing
because you're there to support Fairway or CCM or whomever, right?
Exactly.
Are you finding? So we've seen through the MBA application statistics that these ARMs are starting to really pick up, and that always happens when the rates spike up, right? So no shock there. But I know when I've talked to my parents who are not maybe as financially literate as some others, they hear the word ARM and they go, wasn't that movie with who's that guy from The Office? And how did things work out there? Terrible, The Big Short, right? There's kind of this fear that these are dangerous products, that you shouldn't be messing with them, that there are ninja loans coming through. Are customers getting more sophisticated about using the non-Fannie Freddie kind of standard mortgage products?
I think the best LOs are getting more sophisticated about explaining them. Right? I think that's what's really important. So again, like if I buy a home every 6 or 7 years as a customer, as a client, like it's very rare that I'm keeping up with things until I'm like thinking about buying again, right? That's what most people are going to be like. And so if I'm a loan officer in this environment, I always recommend just know everything you possibly can about every other product that's not the 30-year fixed mortgage, and you're going to stand out like crazy in this market. Right?
I mean, I heard a statistic when I was at the Atlantic City conference that something like only 30% of LOs even could do non-QM. How do we start to bridge that gap and get them more into it? Because it's difficult for a lot of lenders who don't have the infrastructure. It's like, okay, we could start now. Sure. But it's going to take at least 6 months to get anyone who knows how to do it, to build out the competence, to have the lawyers review it. Like, where would you start if you're a lender who hasn't set up kind of a non-QM focus with these products?
I would just start with the broker channel. I mean, I know that even if you're a retail lender, just start with the broker channel.
They're mostly doing it anyway, right?
They're mostly doing it anyway. So why not? Like there's so many there's specific wholesale lenders that literally just focus on non-QM products, and that's what they do. And so if you want to take it into your business and do it yourself, that's fine at scale, maybe because economics are going to be better and all of that. But in the short term, just have the product. It'll help you get in the door with these agents. And I think what's really cool is you're not going to be using them every single day, right? Like, yes, people are really interested in them. They need them in a lot of cases. But if you can hook the agent on, hey, I offer this and that non-QM product, I offer bank statement loans, I offer DSCR, I offer buy before you sell, right? If you offer these types of programs, you can get in the door with these agents and they will send you their normal business to you as well, their conventional business over time. So I think it's a great way to just stand out in the industry today.
And even forgetting like possibly getting standard vanilla loans out of these or working with these agents on that. If you are working with an agent who has real estate investor clients, you might find a guy who's going to do 20 loans with you in a year, right? And probably some bridge products too, right? So if you don't know how to use them, I think you're probably at a competitive disadvantage as we start to see these affordability issues really kind of calcify.
100%.
Right.
100%.
Nick, thank you so much for joining me. It's been a pleasure. I really appreciate it.
It's been great.
All right.